Ladies and gentlemen, good morning and good afternoon to you all. I'm Wael, Sawan, the Upstream Director at Shell, and I really appreciate you making the time to join us for this session for our upstream strategy. For those of you who don't know me, I joined Shell some 24 years ago as a project engineer, and I've had the opportunity since then to work in our upstream, downstream, and our integrated gas businesses. Before taking on my current role in 2019, I led the Deepwater business for 4 years, and before that, I had the opportunity to lead our businesses in Qatar. Today, I'm joined by various members of the upstream leadership team. Firstly, Sinead, the CFO of our upstream business, will join me to discuss in more detail some of our broader upstream strategic elements that we introduced at our recent strategy day. We will also be joined by Paul, Gretchen, and Zoe, who lead our Deepwater, Shales, and conventional oil and gas businesses respectively, and who will update you on some of the exciting opportunities across our portfolio. We plan to first run through around 45 minutes of plenary presentation and leave plenty of time thereafter for your questions. To ask a question, you'll need to be dialed in via the phone line found in your invite materials. Now, before we dive in, let me first show our cautionary note that we always share relating to any forward-looking statements. Let me begin with our investment case. We believe Shell has an important role to play in the energy transition. At our strategy day in February, Ben introduced you to Powering Progress, our strategy to accelerate the transition of Shell into a provider of net zero emissions energy products and services, and our upstream business is going to be a crucial part of this strategy. Powering Progress is set around 4 main goals, with the intent to deliver value for our shareholders, for our customers, and for society as a whole. Generating value for our shareholders means delivering strong returns by taking a dynamic approach to managing our portfolio, continuing with our financial discipline, and ensuring we are ready to realize future opportunities in the energy transition. Powering Progress also means powering lives. From supplying affordable and reliable energy that is crucial to the global economy today, to the work that we are doing to become one of the most diverse and inclusive organizations in the world. It's also about achieving net zero emissions by partnering with customers, with businesses, and society as a whole, to address the problem of greenhouse gas emissions in the atmosphere. Shell's target is to be a net zero emissions energy business by 2050 or sooner, in step with society. This means net zero emissions from our operations, our scope 1 and 2 emissions, and also net zero from the end use of all the energy products we sell, our scope 3 emissions. Finally, Powering Progress also means respecting nature, by stepping up our environmental ambitions to protect and to enhance biodiversity. Shell has 3 integrated business pillars, and each has a critical role to play in delivering our strategy to ensure that we have a strong, profitable, and resilient company now and well into the future. Our upstream business, which we will focus more on today, aims to responsibly manage our advantaged oil and gas resources. This upstream business has a clear purpose: to build on the legacy we have of delivering reliable and affordable energy that are essential for modern life, while at the same time generating material cash flow that underpins shareholder distributions and funds our growth pillar through the energy transition. And this transition is already happening, of course. Around 70% of the world's global CO2 emissions is covered by net zero commitments that have either been adopted or are in the process of being adopted by national governments across the world. And at the same time, our customers are increasingly demanding lower carbon energy products. The pace of this change will vary depending on the customer and the region, and Shell is playing an important and a leading role in that transition. But even the most ambitious scenarios tell us that as the world transitions, it will continue to need oil and gas for many decades to come. You'll no doubt have seen analysis of the IEA's net zero by 2050 scenario that was published just last week, including its assertion that in that scenario, there would be no further need for new oil and gas supply projects. While it sets out an alternative pathway to our own Sky 1.5 degrees C scenario, both underscore the urgency and the importance of ambitious policy, unprecedented collaboration, and dramatic changes in the way the world consumes and produces energy. For us, this all means that we must have the highest quality upstream business possible. An upstream business that is focused and leverages our core strengths. An upstream business that is resilient to oil and gas prices as well as to carbon. And an upstream business that is highly competitive. This has been and will continue to be our focus going forward. Now, as we look to the future of upstream, we do so from a starting position of strength, with a business that over the last 5 years has been focused on value over volume. Our upstream business has generated more than $75 billion in CFFO excluding working capital over the last 5 years at an average oil price of $55 a barrel. And over that same period has generated around $25 billion in organic free cash flow to Shell. While of course we are proud of this performance, make no mistake, this does not mean business as usual for us in upstream. Powering progress will radically transform Shell over the next 30 years and will require our upstream business to step up even further if we are to achieve Shell's ambitions in the energy transition. This will be reflected by the portfolio choices we make as we high grade and strengthen our upstream portfolio. It will be reflected in our investment choices as we focus our CapEx program on our differentiated core positions to sustain material cash generation. And it will be reflected in the way we do work every single day, aiming to safely grow our margins by leveraging the strength of our integrated capabilities as an enterprise and digitally enabling our people. And I firmly believe that digitalization will be a key enabler to help us get to our full potential as a business. It's fundamentally changing the way we work, helping enhance our recovery from reservoirs, reducing development time and costs, as well as improving performance, reliability, and safety along the way. Let me give you just a couple of examples. We're using advanced data analytics on our critical equipment, such as our valves, to prevent incidents and avoid unplanned interruptions. We've also applied analytics in our subsurface, where if you take an example of the Gulf of Mexico, we have taken some 3,300 trouble events over 25 years of well history, integrated them into a user-friendly tool, and complemented them with 6 AI models, allowing us to streamline the process of identifying subsurface hazards and optimizing well plans to avoid or mitigate risks. This saves millions in costs. It saves on emissions due to less non-productive time. And of course, it improves safety of our operations. And that's just scratching the surface of the full value potential that I think we can unleash from digital. Now, our ambitions all begin with being the most responsible operator possible. And this starts with safety. In 2018, we rolled out our process safety fundamentals, which was not about new requirements, but a renewed focus on the rigor that we had to have in following our existing operating practices. Over the past 5 years, we have achieved an almost 50% reduction in the higher risk process safety incidents. Operating responsibly is also about protecting the environment by delivering on our climate targets. Today, our upstream business has made good progress. We have reduced the total scope 1 and 2 emissions of our portfolio by more than 25% since 2016, and we've cut our routine flaring in our operated assets by more than 65% in that same time period. We're on track to fully eliminate routine flaring by 2030. Our upstream activities are also essential for the economic development of the countries in which we operate, from providing vital energy for homes, businesses, and transport, to supporting economic growth, and of course, to the investment in and the development of local talent. And it's this talent base that we have across upstream that will deliver our ambitions. As we reorient our company towards the energy of the future, our people will continue to proudly deliver the oil and gas that the world needs today, while supporting the Shell Group in areas of adjacency, such as developing offshore wind farms, materially growing our CCS business, and leveraging our current positions to support our host governments on their own transition journeys. We have outstanding people that are committed to playing their part in support of Shell's transformation by ensuring that Upstream delivers to its full potential. And it's the same group of people that have already delivered significant improvements over the past 5 years. We've reduced our unit development costs by around 50% since 2015, and reduced our unit operating costs by more than 25% over the same period. Our controllable availability has also significantly improved, reaching around 90% last year. This means more uptime for our assets and more cash generation, even in a world like what we saw in 2020, where our people were also managing through the pandemic. All of these improvements have led to an almost 70% increase in our Upstream unit cash flow from operations versus where we were in 2015, recognizing as well that in 2015, oil prices were higher than what we saw in 2020. Our focus over the last few years around resiliency, operational excellence, reducing costs, and high-grading our portfolio are what puts us in a position of strength. When we look at our combined Upstream and integrated gas business to be able to compare with our peers, not only are we by far generating the highest cash flows compared to our peers, they are also the highest quality cash flows, as you can see when you look at the CFFO per barrel metric. We also have the most diversified portfolio, diversity that provides us optionality. We have long plateau advantaged positions in our conventional oil and gas business, short cycle opportunities in our Shales business, and world-leading high-margin deepwater and integrated gas businesses. And on our carbon metrics, which are an important part of our investment decision-making process, we also are well ahead of other operators when it comes to carbon intensity on a Scope 1 and Scope 2 basis. But as I said earlier, we are not satisfied with the status quo. It is this track record of improvements, this position of strength, and this organization and its capability that gives me great confidence in being able to achieve much more. So what do I mean by more? For Shell Upstream, this means structurally reducing risks while delivering material cash flows and improving returns. We will do this by becoming more focused, more resilient, and even more competitive. We will focus our portfolio on our 9 core positions that generate around 80% of our CFFO. This is a unique and diversified portfolio with access to significant price upside, where we have deep expertise and where we have leadership positions with decades of history. As we high-grade our portfolio, we will use both an economic and a carbon lens in our decision-making. Our positions outside of our core ventures will be operated under a lean venture model, which Zoe will talk about in just a moment. There are also parts of our core positions where we are reviewing portfolio options. At Strategy Day, we talked about our onshore oil portfolio in Nigeria, where we have faced a consistent environmental challenge, mainly because of leaks caused by sabotage and theft in areas where security is a serious problem. The balance of risk and reward associated with our onshore oil portfolio in Nigeria is simply no longer compatible with our strategic ambitions. Because of this, we have started discussions with the Nigerian government to align on a way to move forward. From an investment perspective, we will be disciplined in our deployment of capital and will look to make replicable project investments with low break-even prices and faster payback times. And we will continue to look to reduce our cost structure further, with an aspiration to reduce costs by an additional 20 to 30% by 2025 compared with our 2019 cost base. This focus, discipline, and continued drive for improvements in our underlying performance will enable us to provide the energy that the world needs, and at the same time, to provide the best returns for our shareholders. Now with that, let me hand over to Sinead to talk through our funnel of opportunities that will drive our cash flow generation.
Thank you, Wael, and hello to everyone on the call. My name is Sinead Gorman. I'm the Executive Vice President for Upstream Finance. Since I joined Shell in 1999, I've held a variety of positions in different parts of Shell, including trading, mergers and acquisitions, Shales, and EVP finance for integrated gas and new energies. I've been the EVP finance for Upstream since late 2019. So in order for us to provide the energy that the world needs today, we must ensure we have a strong project funnel and resilient future development opportunities. Our current funnel of projects is robust, with more than 400 kBOE a day of new projects under construction, and a multiple of that which are pre-FID. The projects listed here are only a subset of our portfolio, representing around 50% of volumes, including Shales. And if I look at our broader 2P and commercial 2C resource base, we have over 20 years of production in our funnel. Our upstream business will attract around 30 to 40% of Shell's total capex between now and 2025. With this 7 to 9 billion per annum of capex, we will be selective in the projects we pursue. They will be projects where we have clear competitive advantages, subsurface expertise, strong integration value, and can offer the highest returns. We currently have an attractive portfolio of forward projects with an average forward-looking break-even price of around $30 per barrel and an average portfolio IRR between 20 to 25%. Going forward, approximately 80% of our investments will be into our core positions, and the majority will be in our deepwater business. We've been focused on value over volume for many years now, and this has been key to driving our increase in unit cash flows. The future projects we choose to bring to a final investment decision will also have this same focus. Replenishing our portfolio to sustain material cash flows into the 2030s will also require some continued exploration, with a focus on differentiated opportunities. Our exploration team has made a significant discovery in the Gulf of Mexico with our Leopard discovery that we announced earlier this month, extending our track record in the Deepwater Gulf of Mexico after the Blacktip discovery in 2019. We have also seen continued near-field exploration successes over the last few years, with multiple wells in PDO Oman, Malaysia, and in BSP Brunei. And we have added exciting new exploration acreage to our portfolio with the Cosmos deal last year, for example. So going forward, we will spend around $1.5 billion per annum on upstream exploration, and we'll develop projects that meet our expectations of payback by 2035. Our exploration strategy, like our development strategy, will be focused on value delivery, not volume. The majority of our exploration spend will also be focused on our core positions, ensuring that we continue to keep our hubs full and leverage off our quality positions and deep expertise. There will be some frontier and emerging exploration we will pursue, and this will be focused in basins where we believe we have differentiated subsurface understanding. An area of focus for us will be pursuing opportunities around the Atlantic margin basins, as you can see here. We have an exciting exploration drilling campaign in the next few years, mostly in deepwater, for example in Gulf of Mexico, both on the US and Mexico sides, Sao Tome, Suriname, and Namibia, to name a few. And after 2025, we will not pursue any new entries into frontier positions. I believe that our top quartile drilling performance and our focus on basins where we have deep subsurface knowledge gives us a real competitive advantage. Paul will go into this a little bit more in a minute. Before we move to hear from the various business leaders, let me spend one more minute on cash flow generation. As Wael mentioned earlier, with our combined upstream and IG businesses delivering higher total and unit CFFO than our peers, we have demonstrated not only how we can maximize value from our assets, but also how we can generate differentiated value from integration. With the changes we are now making in our strategy, we expect a continued strong performance across a range of commodity prices. If I just take 2020 as an example, our core assets delivered $5 per BOE higher unit CFFO compared to the rest of the portfolio. And as we talked about at Strategy Day, our total oil production is expected to have peaked in 2019, and we expect our oil production to gradually decline by 1 to 2% a year, including divestments, until 2030. We also expect the percentage of total shale gas production in our portfolio to gradually rise to around 55%. Our upstream business is free cash flow positive at $40 a barrel, and our positions have significant access to price upside. For every $10 increase in Brent, we expect our upstream business to be able to generate an additional $4 billion in cash flow per year. This underpins the material and resilient cash generation we expect from our upstream business into the 2030s. Now with that, let me hand over to Paul.
Thank you, Sinead. Hello, I'm Paul Goodfellow, Executive Vice President for our global Deepwater business. I've been with Shell for 30 years, where I've worked in operational and leadership roles in wells, Deepwater, onshore, offshore and Shales. For 2 years, I served as the VP for the UK and Ireland before being appointed as the EVP of Wells in 2017. And I took over as the EVP of Deepwater in 2019. As Wael mentioned, delivering our strategy requires the best possible upstream, and that will mean unlocking greater value from Deepwater. Our 4-decade history is filled with great successes, notable challenges, and a resilient spirit. And today, with 2 prolific basins, an exciting exploration portfolio, and a track record of strong operational performance, we have a significant competitive advantage in Deepwater. Over the last few years, we've also proven we're capable of further improvement. And we have many examples that bring this to life, but a few that stand out. In 2018, our availability across Deepwater was 85%, and in 2020, we reached 90%. This advance resulted from improving our asset management systems, allowing us to identify and mitigate risks to our production. We've reduced our unit development costs by around 50%, and our unit operating costs by 40% since 2015. Last year, we drilled our lowest cost, most efficient deepwater wells ever in Brazil. At a cost of $34 million, our Saturno well went from spud to total depth in 20.6 days, a best-in-class result, and 25 and 35% below the median time and cost performance across the industry in Brazil pre-salt wells. In totality, these examples, and many more like it, mean that in a $60 a barrel oil price environment, we're able to realise CFFOs greater than $30 a barrel. As others have mentioned, Shell's strategy includes increasing investment in lower carbon energy solutions, while continuing to pursue the highest returns and most energy efficient upstream investments. The Gulf of Mexico isn't just about cash generation. Our US Gulf of Mexico production is amongst the lowest greenhouse gas intensity in the world for producing oil. Even with these improvements and advantages, we know that there's more to do. Let's take a look at how we'll generate even greater value from our assets. We aren't focused on doing deepwater everywhere. We're focused on delivering greater value from our advantage positions. For example, as part of the Perdido Phase 2 topside turnaround, we increased capacity by 30,000 barrels per day. And through data science and analytics, Perdido, originally designed for 82% availability, is currently operating at 93%. We look at our portfolio as a collection of urban communities or corridors that can learn from each other and work together to drive better outcomes on a larger scale. Corridors give us the options and alternatives that you just don't have if you're a single block operator. As Sinead mentioned earlier, we'll focus our exploration spend and invest over 70% of that in deepwater. So let me give you a sense of what that looks like. In the Perdido corridor, we've been able to explore for bigger opportunities like we've done with Wael, Blacktip and Leopard. With this focus, we can optimize our infrastructure, including pipeline to shore, to unlock the full value potential of our discoveries. But this urban planning isn't unique to Perdido. It's at the heart of value creation in deepwater and speaks to the value that these strategic corridors represent. Here's a very simple example that highlights the benefit of this coordination. In 2015, we had more than 60 supply vessels to support our Gulf of Mexico operations. Through improved planning and resource sharing, we've reduced that to less than 15. And in Brazil, by taking a similar approach, we've realized a 25% cost reduction for supply vessels over the last 2 years. Now let's look at how replication is making a difference. Prior to our veto final investment decision, we recognized an opportunity to reproduce the host for Wael, which is up for final investment decision later this year. By leveraging the construction and supply chain of Vito, Wael will go from discovery to first oil in approximately 7.5 years and feature top quartile subsea facilities. And this cycle time includes the impact from COVID cash preservation efforts that delayed the project FID by approximately a year. With a 99% replicated hull and 80% replicated topsides, the benefits go beyond reducing cycle time. We've realized months of reduced engineering time, resulting in significant savings in engineering costs on both the hull and top sides, as well as greatly improved manufacturing outcomes for the replicated topsides equipment. While I trust the power of our corridors is clear, it's actually our unique capabilities and advantage positions that show our true upside. We'll build on our strengths to drive better business outcomes, not just at an asset level, but across Deepwater. We've proven that we're best in class at well delivery, but we know there's an opportunity to take even more costs out. We've adjusted to a franchise model where we've gone to a limited number of standardized well types that cover our global Deepwater portfolio. We've gone from 18 well archetypes to 3 and from 14 completion archetypes to 4. This method, similar to the franchise models of fast food restaurants around the world, brings together the right materials, services, people and procedures to reliably deliver world-class business outcomes regardless of location. And this launches a domino effect of efficiencies internally and in the supply chain. From a supply chain perspective, we're partnering with key suppliers to develop standard work packages based on a set of well archetypes to be deployed globally. This simplified and standardized approach has delivered an additional 20% cost reduction in the last 2 years in the Gulf of Mexico, where we've been developing it. But we know our more recent successes aren't enough. With our advanced assets, we are capable of more. We'll build on our strengths and learn from all of our challenges so that we can deliver even greater value from this business. And with that, let me hand over to Gretchen.
Thanks, Paul. It's a pleasure to be here today. For those of you who don't know me, I'm Gretchen Watkins, Executive Vice President of our Shales business and President of Shell in the United States. I took up those roles when I joined Shell in 2018, and before that, I was the CEO of Maersk Oil based in Copenhagen and previously worked for Marathon Oil and BP. Shales has been on a significant improvement journey over the last couple of years, a journey that's transformed our business by focusing on a high-graded portfolio, improved capital efficiency, strong operational performance, and a simplified operating model that has significantly reduced costs, all of which underpins strong cash flow generation. To achieve a high-graded portfolio, we've divested from non-strategic assets for strong valuations, allowing capital to be focused in our preferred basins. We divested our dry gas positions in the Haynesville and Appalachia in the United States. In Canada, we exited our Foothills sour gas business, and in April of this year, we completed the divestment of our Fox Creek and Rocky Mountain House assets. In fact, our current portfolio has generated more CFFO in 2020 versus 2017, despite a smaller asset footprint, the impact from COVID-19, and prices that were 23% lower. This cash generation is a testament to the progress that we've made on our competitiveness journey. In 2020, we also transformed our operating model, resulting in more disciplined execution and 40% fewer handoffs. Our operating model puts us on track to see a further 30% reduction in costs by the end of this year. And more importantly, we are a smaller and more nimble organization. We have clearer accountabilities, simplified processes, which enable our teams to boldly take the business forward. Now let me highlight a couple of our assets. In Canada, our Ground Birch Montney natural gas asset continues to show additional potential through resource maturation and excellent well performance. The Ground Birch asset is uniquely positioned at the inlet of the Coastal GasLink pipeline. By sharpening the focus on execution and cost reductions in the Shales portfolio, Ground Birch has reduced its break-even price by some 20% since 2018, and it will offer a lower cost of supply than the local AECO market. As a result, we can confirm today that Ground Birch will provide the majority of the feedstock for LNG Canada Trains 1 and 2. Our Argentina asset sits in the Vaca Muerta, where reservoir quality matches the Permian. We have a large position in the best part of the basin, and we are ramping up oil production while continuing to appraise and unlock development potential. Wells that we have already drilled in the black oil window have exceeded our expectations. And now to the Permian, which delivers the majority of our high margin volumes and free cash flow for our Shales business. Permian is an upstream core asset, and it will attract the majority of the capital within our Shales portfolio. We have a very attractive Permian position with more than 500,000 acres in the Delaware Basin, in areas with the thickest formations. We have some of the highest oil yields in the basin and have de-risked 8+ years of Tier 1 inventory. We've seen a nearly 60% reduction in drilling and completion costs and a 53% reduction in unit operating costs since 2015. Here, technology is an enabler to the significant reduction in well costs. We use remote real-time monitoring and automation in our drilling activities. This capability allows us to deploy Shell proprietary AI techniques to optimize and continually refine our drilling parameters, leading to more capital-efficient wells. We are looking for cost-saving opportunities everywhere. For example, we've reduced our flowback costs through automation and simpler designs. This also improves our cycle time. It increases early production by almost 20%. Additionally, we've started using our own sand traps and tanks, eliminating more expensive rental equipment. We continue to progress development while looking for opportunities to consolidate and enhance our footprint. We're focused on strong operational performance and competitive cost structure. With prior infrastructure investments, we are now in our drill to fill stage here. We have forward-looking IRRs greater than 50%, break-evens of about $30 a barrel, and paybacks within 2 to 3 years. We also capture additional commercial value through our trading and supply business. This integration enables Shell to reach the highest value markets and manage price exposures to increase the resilience of our investments. And as communicated in our first quarter results, the Permian has delivered 3 consecutive quarters of positive free cash flow. So now I want to talk about our efforts in the Permian to reduce flaring and emissions. Shell places a high priority on reducing methane emissions, and we support the direct regulation of methane. We have actively worked to significantly reduce our emissions, and as a company have announced a target to maintain methane intensity below 0.2% by 2025 for operated oil and gas assets. This is an area that I personally am very passionate about. Today in the Permian, we have top quartile performance in limiting methane emissions, and we are already below our 0.2% methane intensity target. Since 2017, we have reduced our greenhouse gas and methane intensity by around 80%. We also have reduced flaring by more than 80%, all while increasing our production of Shell-operated assets by nearly 120%. We've implemented infrared cameras along with drone technology as a means to improve methane emission leak detection and improve the speed of repair times. For example, drone-mounted detection cameras feed information to an artificial intelligence-based analytical platform, which is able to detect and analyze methane leaks from images collected by this camera. This produces a simple data analytics set, and within 24 hours of a drone survey, we have all the information that we need to identify a potential leak, dispatch a maintenance crew, and remediate that leak. We've also stopped all routine flaring in the Permian Basin since 2018, and we applaud others who are moving in that direction now. With that, let me hand over to Zoe to talk about our conventional oil and gas business.
Thank you, Gretchen. It's great to be with you all today. I'm Zoe Yujnovich, the Executive Vice President for Conventional Oil and Gas. Let me also briefly introduce myself. Prior to my current role, which I took on in January of 2020, I was the Executive Vice President and Country Chair for Shell in Australia, where I was responsible for our integrated gas assets. Before that, I was in Canada, leading our heavy oil business, including both oil sands and unconventionals. This is where I joined Shell in 2014. Before then, I worked with Rio Tinto as the CEO of our iron ore company of Canada, and prior to that, with the company president for Brazil. Conventional oil and gas is the heart of our upstream business, as it spans our legacy positions, which we've developed and operated over decades. Over the years, this portfolio has proven to be a material cash engine. The diversity of the portfolio also provides price resilience, given the mix of production sharing contracts and tax royalty agreements. This was evident in 2020, when our conventional business delivered around 60% of the $4 billion organic free cash flow for upstream. We're also well positioned to take advantage of price recovery and upside, as we demonstrated in our recent upstream Q1 results. To sustain this cash generation capacity into the future, we're focusing the majority of our capital and resources on 6 core positions: 3 key operated countries in the UK, Nigeria and Malaysia, and 3 non-operated positions in Oman, Kazakhstan and Brunei. We have unique leadership positions and competitive advantages in these countries based on our subsurface knowledge, integrated value chains, decades of production experience, deep relationships with governments and partners, and very talented local staff. These 6 core positions provide longevity through production optimization, new project developments, and also have near-field exploration running room, which will allow us to sustain cash delivery well into the 2030s. As we focus on our core positions, we are significantly reshaping the portfolio. We've made good progress with the divestments of non-core assets, as you can see on the map. Earlier this year, we announced the divestments of our onshore Egypt assets, and last week we signed a deal to sell our interest in Malampaya in the Philippines. The divestment of our ventures in the Baram Delta in Malaysia is in progress, and we're also intending to hand back our upstream licenses in Tunisia to the government in 2022, when the Miska license expires. In Nigeria, we divested OML 17 earlier this year, and as Wael mentioned earlier, we're also discussing portfolio options for our remaining onshore oil positions in Nigeria with the Nigerian government. Looking forward, we will concentrate our efforts on our deep water and gas value chains in country. Focusing our portfolio will also allow us to further drive our operational performance and project delivery. Already, our capital efficiency has improved by around 45% over the last 5 years, and we've reduced our unit operating costs by around 10%, while keeping our controllable availability close to 90%. But there's more improvement potential as we leverage our extensive subsurface and operational data through advanced data analytics and digital technologies. In PDO, for example, the team implemented a new digital web-based system called Takamul, the Arab word for collaboration. This optimizes well planning and delivery, coordinating more than 30 rigs, more than 100 fields, and more than 700 wells. In 2020, almost 2 million barrels were accelerated, generating an incremental cash flow of more than 200 million. The other unique feature of our core positions is that these upstream assets are part of an integrated value chain with integrated gas, trading, and downstream. This allows us to maximize the value of our molecules and positions us strongly for the development of new value chains as we move towards net emissions or net zero emissions. Let me turn to the UK as a great example of what we're doing in this space. The UK is a core part of our portfolio. We operate around 10% of the total UK oil and gas production. Our cash flow from operation unit margins in the UK are very attractive and resilient, and among the best in our upstream portfolio. Our UK team increased production by more than 50% since 2015 after divestments. And the 7 major project FIDs we took in the last few years, and with several upcoming, will result in further growth in the years to come. Our UK portfolio can essentially be segmented into 2 parts. The first is the high margin oil FPSOs, where we'll focus on project replication, standardization, and selective growth. And the second is in natural gas, where we expanded our unique integrated value chain from wet gas to chemicals. We realise that the external context is changing at pace in the UK, and the UK government is a front runner in developing policy and legislation to achieve net zero emissions. We are also committed to achieving net zero emissions in the UK and have made good progress to reduce our upstream emissions over the last 5 years. But as the landscape changes and shifts quickly, so are we, and we need to do much more. As we continue to develop our UK portfolio, we're actively pursuing a funnel of projects to further reduce our direct emissions through brownfield abatements, offshore electrification, and selective portfolio high grading. We're also well placed to develop new value chains for blue hydrogen in combination with carbon capture and storage, addressing both Scope 1 and Scope 3 emissions by leveraging our gas assets and strategic infrastructure positions. For example, we're participating in the Acorn project, one of the largest and most mature carbon capture and storage and hydrogen projects in the UK, which is centred around our St Fergus gas plant. St Fergus receives large volumes of natural gas from UK offshore production and Norwegian imports and plays a critical part in supplying the UK's energy needs. By reforming the gas into blue hydrogen and storing the carbon dioxide into nearby depleted fields through currently Shell-owned and operated infrastructure, the Acorn project has the potential to decarbonise industry and homes across Scotland and the UK, and the ability to store over 5 million tonnes per annum of CO2. To enable these types of developments, the upstream industry and the UK government have recently entered into the North Sea Transition Deal, in which Shell is a partner. This deal brings together a package of commitments and measures that will facilitate supply decarbonisation while building policy frameworks, capability, supply chains and investments in clean technologies, all while supporting jobs. It's a powerful example of what can be achieved when government and our industry work together towards a common goal and can serve as a blueprint for other markets. Finally, let me also spend a few words on what we're doing in our lean portfolio. Last year, we identified 11 lean positions in our conventional portfolio, including countries such as Italy, Norway, Netherlands, and Iraq. Since then, we've taken this number down to 8 with the portfolio decisions I mentioned earlier, showing evidence of our early action, despite the challenges of 2020. My ambition for the lean portfolio is twofold. Firstly, to drive high performance in the assets, evidenced by reducing OPEX by more than 40% in the next 3 years, increasing free cash flow by more than 30% compared to a 2019 baseline, and turning them into agile organisations, demonstrating our ability to drive a fit-for-purpose control framework in Shell. And secondly, to assess if these ventures have the potential to become core by unlocking significant materiality, and if not, to divest for value over time. Critically, the value in segmenting our conventional portfolio is not only in the focus that this brings to our lean assets, but the clarity of purpose for the Shell Group on our core asset positions as well. We will manage our lean assets with a new operating model based on 6 key principles: more frontline autonomy and decision authority within the ventures, a small supervisory team with lower central overheads, and more stringent investment hurdles for projects and exploration, steering towards faster paybacks. The differentiated operating model means that in general, the lean ventures will function with more autonomy, be liberated from the complexity so that they can focus on cash generation. Learnings will be taken from lean and implemented broadly across our upstream organisation at every relevant opportunity. We've already taken the first steps to implement this model, and I'm confident we can achieve these objectives within the next few years. Now, let me hand back to Wael.
Thank you for that, Zoe. Let me now wrap up before we open up for questions. At our strategy day in February, we introduced you to Powering Progress, our strategy to transform Shell, and today we built on that, hopefully helping to explain how this translates to the upstream business. In short, we believe our upstream business has a critical role to play in responsibly providing energy that the world needs today and providing the financial strength to transform our company and to fund our shareholder returns. In recent years, our 3 lines of business have made good progress, building a compelling investment case through their competitive portfolios, attractive growth options, and differentiated operating models. To support Shell's ambitious transformation, Upstream needs to continue to push for more. We need to become more focused, more resilient, and even more competitive. And our upstream business is well positioned to deliver that.